These days, it's very difficult to talk about any other topic other than the coronavirus, and we can see the impact that the virus has had on all the different stock markets. So, having a quick look at the S&P 500, we can see that in the last day of trading, there was a 4.42% drop, and also with the Dow Jones, which recorded its biggest point fall in history, and that equates to around a 4.4% decline. So with that said, I want to look at my portfolio, analyze where areas need to be improved upon, and so I'm going to pick 3 of the worst hit stocks and try to understand whether it's related to the coronavirus or not. Now, before I start, I just want to remind everyone that I focus on dividend-based companies, and in recent times my account has taken a hit. And so currently my portfolio is at negative 8% roughly. So what that tells me off the bat is that given that I'm exposed to the US and the UK market primarily, my account is seeing the impacts from the 2 different global markets. Okay, so let's look at one of the most hit companies, and that is Walgreens Boots. So we can actually see that in mid-November that the stock has been on a decline ever since. But the reason why I bought into the company is because Walgreens Boots has a dividend yield of 3.73%. Now, unfortunately for Walgreens Boots, the company has struggled to be profitable in terms of the pharmacy sector. So we can actually see from Seeking Alpha that Goldman Sachs has listed Walgreens Boots as a dividend all-star, which simply means that for a dividend-based stock, it ticks all of the boxes. Now, the reason most likely why the stock price has been decreasing in recent times is because of the limited progress on in-store healthcare initiatives. And we can see here that both CVS, Rite Aid, their retail pharmacy stocks have risen, while Walgreens is down 28%. And we can see that from the graph here, so negative 28% for Walgreens Boots. And the other 2, so Rite Aid at 4.79% and CVS at 11.1%. So this alone makes sense as to why the stock price has decreased. Now, one could infer that with the coronavirus, pharmacy-based companies really take a toll during this time, and that's just because there is no preventative measure. And so maybe individuals are buying more off-the-shelf medicine, but it's not helping to treat whatsoever. Now, I'm not really sure if that's the reason why the stock price of Walgreens Boots has dropped, but we can see that there is retail failure within the pharmacy sector of Walgreens. And so this price drop can be mainly attributed to such a factor. Now, in terms of my actions, I've noticed this price drop in, and unfortunately there is no bottom in sight. We can see that we've already crossed some of the price levels back in August of 2019, and so we are at new all-time lows. So what I have done is I have brought in, but the stock price has kept continually dropped. Given that my focus is long-term, I don't have a problem buying when the stock price hasn't fully bottomed out. Now, everyone has different investing strategies, but that's the one that I take. Okay, so let's look at the next stock, which is that of Wells Fargo. So Wells Fargo supports a dividend yield of 4.62%. Now, currently, with respect to my average purchasing price of Wells Fargo, I'm at a loss of 11.41%. Now, in the grand scheme of things, it doesn't really matter. I have 1.42 units of the stock. Now, Wells Fargo has struggled from a completely different problem. We can see that Warren Buffett recently mentioned about Wells Fargo's fake account scandal and labeled it as a total disaster, and we'll see that clip now.
Well, banking is a good business if you don't do dumb things on the asset side. I know that they paid $3 billion because it was announced. I don't know what else is outstanding, but Wells Fargo is classic in terms of one lesson. My partner, Charlie Munger, he says, whenever we have a problem, you attack it immediately. He says an ounce of prevention is not worth a pound of cure. An ounce of prevention is worth a ton of cure.
So Wells Fargo agreed to a bank settlement of $3 billion. And for those that are unaware, the Wells Fargo fake account scandal basically meant that accounts were being open without customers' permission and they were charging fees. And so as a shareholder, there is no net benefit given that the growth is superficial. In addition, Wells Fargo never owned up to the issue straight away. They should have settled much longer ago. And as a result, high investor profiles such as Warren Buffett have sold out of Wells Fargo. So Berkshire sold 15% of the Wells Fargo shares. Now, they are still one of the bank's biggest shareholders, and it's labeled 7.8%. So I would definitely attribute the decline with respect to the scandal just mentioned. So that's all I really want to mention for the company Wells Fargo. It'd be interesting to see where this company heads to in the future. For now, I have such a small value in my portfolio that I'm really not too worried. Equally, I don't plan on adding any more positions into the company. I may do so once I see an uptick in the stock price, so once this curves upwards and then follows by a drop. And that way I can hopefully start buying in at the local minimum. But I personally feel as though there's a lot of other great companies out there that pay dividends, and I'm going to focus my attention on those. Quick announcement. Are you interested in starting your own investment journey and want to receive a free stock worth up to £100? All you have to do is create an account and deposit £30 or more. Trading 212 is available for European residents also, so head over to the link in the description. Okay, so the final stock I want to look at is Simon Properties. So Simon Properties has a dividend yield of 6.35%. Now my account has suffered an 11.83% drop with respect to the Simon Property Group. Now keep in mind I just have one share in the company, so that equates to negative $13 or so. So I want to look at some recent events. So this is just on the investors.simmons.com site, and we can see a list of all the recent activity. So the ones that I want to call out is on February the 10th, Simon Properties acquired Talman Centres. Now, before I talk about the significance of this purchase, we need to understand what Simon Properties deals with. So Simon Properties is one of the biggest mall owners in the US, and the company has a standpoint that the mall sector is going to be profitable even with the likes of different e-commerce websites, the likes of Amazon. And for me personally, I do believe that will still be the case. Now, I could be wrong, but my theory is that if you look at the likes of Apple with their retail structure, they have a very hands-on experience. Companies need to transition into that type of direction, because we've seen time and time again a lot of retail-based companies struggling to keep afloat and have been acquired, for instance. So going back to the acquisition of Talman Centres, so what they do is they are engaged in the ownership, management or leasing of 26 shopping centres in the US and Asia. And so Simon has said, hey, we're really bullish on the mall sector and we're going to take over of existing companies which have struggled recently in the retail sector. Now, if you're bullish on the mall sector, then this acquisition made complete sense. If you are bearish on the idea, then you shouldn't hold Simon as a stock to begin with. So that was the first big announcement. And then shortly after, there was also the acquisition of Forever 21, which was finalized, and that happened 9 days later. So we have Forever 21, which is a retail brand. So we can see here that ABG and Simon Properties, they will each own 37.5%. And then you have yet another company, Brookfield Properties, which will own 25% of the IP and operating business. So it's with no shock to anyone that a lot of retail companies, especially in the clothing industry, have really struggled to keep afloat, and that has led to a range of acquisitions in the past. So with respect to the stock price slumping in recent times, if we look at February the 10th, see that the acquisition of Talman Centres was at this first initial drop here, and then on the 19th we actually had a recovery, the announcement of the acquisition of Forever 21 that gave a little increase in the price, but since then the price has dropped to much lower levels. So when you buy into companies, And the likes of S&P 500, Dow Jones, when they drop significantly, you have to ask yourself, is the given company impacted by the fundamental problem, or are there other problems that are driving the price down? And then does the price drop even more so just because of panic selling? And it's very hard to quantify, but when you look at different activities of the given company, you can start to map out what maybe is causing the price to drop. But it's no shock to anyone that stock prices have dropped everywhere. And so the lessons that I've learned is, although I was aware and I discussed in one of my previous videos, but we need to have companies that can help not only with respect to recessions, but from global pandemics as well. In addition, I think it's a great time to buy more stocks. I do expect prices to continually drop, but if you're like me, you focus on dividend-based investing, then a lot of these companies are on sale, and that can really point your portfolio in the right direction. So I definitely look forward to buying more companies at a lower price, receiving more dividends. I felt it would be great to talk about the market values dropping and how sometimes it can be worrying to see those levels, and there's definitely been learnings for myself to take on for the future. So I do expect a recovery in the future, and at that time I will be looking at different companies to help mitigate. So hopefully you all appreciated this video, and with that said, I'll catch you in the next one.